was welcoming Yogesh. I sent him the link. I was
Good morning, Chad. How are you?
I'm
Hi,
doing
everyone.
but glad that you got my email this morning.
Yes.
So Yogesh is he's coming from almost probably a perspective as an investor. Yogesh came to Canada, and his his ambition is to get into real estate investment from development, and possibly as an investor in buying houses to fix them up. Now, Yogesh, you're in the process of you've got a house that you've purchased and you're in the process of fixing it up now.
Yes.
Right now. So yeah, so once foreclosures start coming back to the market, because during COVID, it was very taboo, I would say, for financial institutions to repossess people's homes, right? Very hard time financially for some people, and they don't deserve, because a pandemic hit, to have their home taken away from them, right? So, so there haven't been a great deal of foreclosures in our market as of recent. Coming up to 2020, I'm sure banks were poised to start taking over some properties, but when the pandemic hit, there was basically a moratorium on foreclosures. But I think right now you're going to start seeing, now that a lot of the COVID restrictions are being lifted, people are starting to get back to the workforce again. I think the CERB is starting to dry up for some people, and they're starting to implement measures to get people back to work. So I would say banks are going to get back on the horse and start looking at recovering some of their money that they have out into the markets, whereby if they feel like a borrower should be repaying them, then they're going to start putting a little pressure on those borrowers to start repaying them. And if they don't, well, unfortunately, they're probably going to have to start taking some legal action. So yeah, we'll see more foreclosures coming up. I would say next year would be the time, 2022. Part of the issue that is also slowing the foreclosure process down, and I'm sure there are some financial institutions that would really like to start getting their money back on properties that are delinquent, or borrowers that are delinquent in their payments. The fact that the law courts are not open for hearings, and they're very backlogged down there. So you have to go to court to petition for a to take the property to foreclosure. You have to get a judgment from the courts in order to send a property to foreclosure, right? So if the courts are not open for the hearings, because they have to present evidence to the court and why they have the right to repossess somebody's home, and if they can't get in front of a judge or have that hearing, then unfortunately they can't proceed with the foreclosure process. So that has been stalling the process, and a lot of foreclosures that would normally be on the market are delayed in the process, and will probably be coming into 2022 because of the fact that there's a backlog in the courts, and they can't have that hearing and get the judgment they need to send the property to foreclosure and sheriff's sale. So we've got Paul McDonald, another guy that likes the idea of buying houses and fixing them up and selling them. Good morning, Paul.
How you doing?
I'm doing great. How are you?
Not bad.
That's good. So Paul, have you decided and pulled the trigger on that property in Dartmouth we were talking about yesterday?
No, I walked away from it.
Oh, you walked?
Yeah, I'm gonna let it go.
Oh, really? Okay, interesting. Yeah. Interesting. All right. Well, that's a conversation for you and I to be continued.
Yeah. Yeah, sure.
Right on. Okay, so it's almost quarter after, guys. We'll give it a couple more minutes, and then we'll start getting into the process. And more so, I guess, for anybody that's online with us here now, I'll just go over a brief summary of from the buyer's perspective, kind of the things that you'll encounter in dealing with foreclosures, bank foreclosures. And then, for the most part, I'll just open it up to you guys to ask some questions. I'll do my best to cover what I can in terms of a brief summary of the process and some of the advantages and certainly the disadvantages of buying a bank foreclosure. And at that rate, once I give that overview or summary of it, then I'm sure that'll spark some questions from you guys and from your side of things. So Sherry, how long do you think it might be before anybody further joins us here?
I just sent a note over to the Scripps group asking if anybody was going to disengage and join into the foreclosure call, because I knew Jen's planning to come over, but like I said, the Scripps call was pretty hot, so we were hitting on some pretty
Okay. All right. Fair enough.
visceral things that we were all kind of feeling at the time. So who knows?
No problem. Well, I think, in fairness to the people that are here, we'll just get started, and it's recorded. So if they want to catch the beginning of it, then they can certainly reel back and catch up from there. Cool. All right. So as I alluded to earlier, I had a long run of working with bank foreclosures, about 15 years, I suppose. I'll speak of the angel here. She appears.
Yeah.
Jen Demings. There you go. Morning, Jen.
Hey, everybody, thanks.
Hi.
Good to see you, Dad.
Good to see you. Yeah, we were just about to get started. Right on. So I received a phone call about, I don't know when I was probably 15, 16 years ago from a friend of mine who was a bank manager, a branch manager for Household Financial down on Roby Street. He was working his way through the system as a collection agent. So this is where I get a lot of my knowledge and experience from. His name is Andy Chandler, and Andy was a collection agent for the bank, for the finance company, calling people when they were in arrears with their payments. And he was also in the sales. He was trying to get their mortgage money out there in the market and their money altogether. So, if you had a recreation vehicle you were interested in borrowing money on, he was pushing that money out. Now, this is a financial lender. So with you guys who have spent some time with me on Wednesday evenings, you know what an equitable mortgage is. So most of the time when I dealt with foreclosures, and before 2008, 2009, when the subprime market crashed, there were a lot of equitable mortgages being taken out on properties, which are second mortgages traditionally. And that, you'd have your first mortgage with a conventional lender and a second mortgage with a high interest lender, an equitable second mortgage. And those are the subprime lenders, where they're not the best position to be in. There's a lot of high risk. So long as they see equity in your home and you've got a job, they're likely to lend you the money. And back in the early 2000s, it was like the Wild West. These guys were trying to get their mortgage money out into the market like crazy. So it was almost as though if you could fog a mirror and you had a job, they were going to give you the money that you were looking for with the equity coming out of your property. Maybe they saw that the prices of homes were going to continue to go up, so the amount of equity in your home would grow organically. I don't know what the idea was, but they were putting a lot of subprime money into the market. Now with that, you've got high interest rates. So the lowest I think I saw when I was dealing with the finance company, HSBC, as it turned out to be, Household Finance was bought out by HSBC. I was seeing a lot of 12% mortgages on houses, when traditionally you could go to a traditional lender like RBC or BMO, Scotiabank, CIBC, one of those lenders, and get 4 or 4.5%. And these guys were lending at 12%. But 12% was a deal when it comes to subprime, because most of the equitable mortgages were at 19%. I saw as high as 22%. Okay. So if you're in second position, you've got your first mortgage and you're paying interest on that mortgage and the mortgage principal payment there. And then you have to also pay a second mortgage with 19 to 22% on average. That's a lot of interest payments that you're paying every month. And unfortunately for those folks, it could be any number of circumstances and the reason why they had to go and take money out. Sometimes people just don't understand they're not responsible borrowers. And if they see the chance of borrowing money, they'll go and do it, right? Just to have. And during the early 2000s, I found that there was a culture of seemingly around the world, because the subprime market everywhere was having a hard time. But there wasn't a gas station or a grocery store or a hardware store that you walked into that somebody wasn't chasing you with a clipboard asking you if you wanted to fill out one of their applications for a credit card, right? So people were getting heavily in debt. Consumer debt was high. In order to pay that off, they were taking second mortgages on their homes. and paying off their credit card debts. And unfortunately, they got on that treadmill that a lot of people just could not get off. So unfortunately, what ends up happening is when they get overextended, they stop missing their payments. Now, ordinarily, they're paying their first mortgages, but they're skipping out on their second mortgage payments. So they start getting behind. And once you start getting behind, and if you've got a fixed income, it's very difficult to get caught up, right? You got to put in for overtime or have a second job in order to get caught up. Because if you're always going to make the same amount of money and your debt exceeds that, then you're either going to continue to borrow or you're going to have to catch up somehow and infuse more money into the situation. And by that, you'd have to get a second job or work more overtime or what have you. So, but a lot of cases, people just did not get caught up, right? Once they got into that hole, it was extremely difficult to get out. So what happens is when at that point, people start getting behind, the phone will start to ring. And the first phone call is your creditor, okay, whomever that might be. Now, I'm talking the Equitable mortgages, but the conventional mortgages are no different, right? If somebody gets behind because they are not paying their bills, the first call that will come in from your first mortgagor or your second mortgagor is, hey, you missed a payment. You've got 15 days to make up for it. 15 days comes and goes, and they're making every reason in the world why they weren't able to make that payment. So the creditors continue to call the collection agents. We need a payment. We need you to square up with us. We need you to get caught up. What can we do to help? Do we need to defer this payment? And sometimes the borrower just knows they're way in over their head. They just will never be able to get caught up. Some know the game, some don't, but it's all in the credit department at this point. However, after 3 to 4 months of not getting proper response, not getting proper reaction out of the borrower, which means we need you to pay something to give us this idea of goodwill, that you are going to pay this loan back and we need to get you back up to date. How are we going to do that? But eventually, when the creditors keep calling and nobody answers the phone anymore, the creditors know we're being ghosted. Okay, there's an issue here. These people they have no intention of paying us back at this point or no ability. So they ignore us. And they won't be ignored for very long. So while this is happening and they're trying to collect, and there are some habitual borrowers that are delinquent, they get back on track, and then 8 months later they fall off the rails, they get behind, and then they get back on track, and so on. So they play that game. However, the finance companies have a system in place and it's a process for them. They call, they don't get any reaction. Finally, they're not getting any payment and their people are being ignored. So finally, if they're getting ignored to a point where, okay, they're a month behind and we're starting to the second month, what will end up happening is all of these banks have management companies, okay? So the management company will be asked to go and take a drive by the property in question. Whoever's delinquent, go and have a look and do an occupancy check. Right. So they drive by the property and they see, okay, what are the signs that the people are here, living here or not here? So if they drive by in the evening, the lights are on and they see people in the house, okay, they're still occupying the home. But they will continue to do that so long as this borrower is in arrears. So whether the borrower knows it or not, they've got some guy driving by or some gal driving by, seeing if they're there or not. Because what happens in a lot of times is they know that they're not able to pay this bill and they're going to have to get out and find somewhere else to live because the bank is going to take their home from them. So they pack everything up and they leave and they abandon the house. And that's why they do these occupancy checks, because they don't want a house to be left unsecured and unmonitored. So these management companies, when they ultimately find, okay, there's every reason to believe that this house has been abandoned. One, the grass is overgrown. The garbage that was here 2 weeks ago is still here. I've gone by, there's no lights on at night. There's been no cars in the driveway at random times that I've driven by, I believe. And then ultimately, they see that the power has a little red tag on it, which means the power has been disconnected. They're all the signs to say this house has officially been abandoned. So they will be instructed to go and engage the homeowner. They'll knock on the door, nobody there. If they in themselves decide this house ultimately has been abandoned, there's no furniture in it, nobody's been around, it looks like it's been neglected for a number of months, the bank will give them an instruction to go in and secure the house. All right, so I've had a lot of calls from people that say, what do those papers mean in the window? Has anybody seen those papers stuck in the window of somebody's home before? No? Okay, so when the management company goes in, they secure the property, they change the locks, they put like boards, or if they have to board up a window or a door or secure it, screw the door into the wall just so that nobody can gain access or entry back into the home. Because what a lot of times is, hey, it's fair game. You know, these people abandon their house, it's going to be foreclosed on before the bank takes it. All these robbers and pillagers go in there and they steal the copper out of the house. Anything of value, they'll try and steal out before it's foreclosed on. So that's why the management company acts very quickly. So anytime you drive by a property and you see those tags in the window, it's generally been secured for the bank, who is ready to initiate the foreclosure process. Okay, it's not always the case, because people sometimes have been relocated through companies and those tags go in the window saying that we are a management company on behalf of a relocation company. So it's not necessarily a foreclosure, but in most cases, and I'm going to say over 90 or 95% of the time, it is a foreclosure situation. Right? Especially if you can see the exterior where a lot of the property has been neglected. Right? There's garbage around. There's the grass is overgrown and the weeds are growing up in the gardens and things like that. So it's pretty obvious that when somebody vacates a property, it's been abandoned, and now the management company has control of the property. For the next step is, now that the bank has established the fact that this property has been abandoned, they've gotten no calls back, no payments from the borrower, it's time to put a case together and go to court. And what they have to do is notify the borrower that they need to come to court and defend their side of things, because not every bank goes to court and gets the judgment for foreclosure. The borrower has the right to be heard as well, and why they're in the position they are, and we are willing to make some sort of compromise. So they have to stand in front of the courts and argue their case as a borrower, and hopefully the courts will side with them and force the bank not to foreclose. They won't give the grant or a judgment for foreclosure. I think there's a reconciliation here, and the judge may order, we're going to suspend this for another month, 2 months, 3 months, so that you can go away and fix the problem. And then, you know, barring the ability to come to some sort of an agreement or arrangement, then you might have to come back and we'll rehear it in a month or two. However, most of the time, the borrower does not show up to be heard. So once that happens, the bank provides their evidence, and the courts will side with them, and they'll send an order for foreclosure judgment out against the property owner, and they will initiate the foreclosure process. Okay, so once that's started, in order to foreclose these, the banks will have to send this property to a sheriff's sale. Okay, so in order to get to the sheriff's sale, you have to have the order for foreclosure from the courts. Once you obtain that, then it's time to schedule the sheriff's sale. Okay, so the property goes on the market, or sorry, goes to the sheriff's sale. Leading up to the sheriff's sale, at one time, the sheriff's department was responsible for marketing and advertising the sheriff's sale. Okay, but that's been taken away from them probably 5 years ago, 5-6 years ago. So now that the lawyers representing the financial institution are responsible for doing the advertising and marketing for the sheriff's sale. Reason being is it gives the opportunity for the public to come and bid against the bank to take the house. So if you wanted to go down to the sheriff's sale personally and buy at the sheriff's sale, you could do that. And so long as you outbid the bank who has the mortgage on the property, then the property is yours. Because at one point, if you go and you say, okay, I believe this property is worth $210,000 and the bank's owed 200. Well, if you go, the bank will stop bidding at 200. And if you bid 210, that house is now yours. Okay. So, but if the bank ends up taking it back and there's no other bidders, at the sheriff's sale, then the bank's at liberty to put it on the market for sale. And they have the obligation to pursue market value, fair market value. Okay, so people are asking, how do I know about the sheriff's sales? At one time, you could go down to the law courts and there's a big bulletin board, which there still is. However, you're not going to see all of the foreclosures on that bulletin board anymore, because if the law firm representing the bank chooses not to post that foreclosure sale on the bulletin board, then you won't ever see it. So, but the sheriffs, when they were in charge of holding the auctions and responsible for doing the marketing for the foreclosure sales, you could always go down there and there was a full page and it would say, you know, RBC versus whoever the homeowner was or the borrower was. And then it went on to say, you know, how much, the details of the mortgage, how much was owed on the mortgage, including the interest that was in arrears that they were owed, for a total sum of, say, $168,000. That's what the bank is looking for. So if you as a private investor want to go down and bid on one of those houses, well, you know the bank's looking for 168. You have to decide, is it worth any more than that to me, right? So that's where the foreclosure sheriff sales auction happens, down at the law courts. And you can go down and look at the bulletin board and attend on that date. They also decide that there are a lot of times the announcement is made that the foreclosure will happen, or the sheriff sale will happen at a certain date, at a certain location, which is down at the law courts on Lower Water Street, whatever courtroom that it's state. And you'll find that advertisement a lot of times in the Halifax Herald. That's one of those go-to marketing places. So if you're watching the Halifax Herald, you'll often see where to find the when and where these sheriff sales are happening. The other spot that a lot of people find the sheriff sales are in, the notifications are in allnovascotia.com. If you have a subscription to All Nova Scotia, you'll often find the advertisements for those. Halifax Herald, I've never seen it in social media personally. Viewpointrealty.ca, if anybody is a subscriber to that. They used to have a foreclosure section, but I don't know if they have that anymore or they maintain it. But that was another source that I've heard was promoting it. Now, I don't use Viewpoint personally, but I've heard people saying that, oh yeah, I saw it on, there's a function on viewpoint.ca that talks about foreclosures. So they must have somebody extracting those and posting them through, but it might be too big of a maintenance thing, because I don't think that they have that foreclosure section anymore in viewpoint.ca. They may still, I don't know, but check it out just in case. So people ask me, before it goes to the market, before it gets listed, how do I find out about these, right? And how does it work? So you can buy that home at any time. Before it goes to the sheriff's sale, you can buy it. And to me, that would be the biggest advantage. Now, Paul and I dealt with a property together, Paul McDonald here, out in Spryfield. When I was doing this for HSBC, and it must have been 10 years ago, I drove by a property a number of times to give them an evaluation. And from my perspective, I was just there to give an opinion of value. If we repossess this home, what do you think it would be worth? And they decide, okay, we're going to lose too much money. We're going to try and continue to work with this property owner to get our money back. But if they're so delinquent that they're never getting their money back, then they have to know, when they send the lawyer to do their bidding at the sheriff's sale to get this house back, where should we stop bidding? Because any beyond that, if we bid and somebody is trying to outbid us and we end up taking the bid and then go to market and we can't get that money back, then we've lost more money than what we were owed. So we have to place a fairly strong opinion of value on those properties for the banks to decide, let's initiate foreclosure and take it back, especially when they're in second place, right? Because if they're never going to get any of their money back, if they're only owed 20 or 30,000 bucks, they may not even bother to show up at the sheriff's sale, because if the property has got so much damage or so much neglect and it's not worth X amount of dollars, and if they take it back and try and sell it, they're going to absorb all of the management fees, the lawyer's fees, the real estate fees, property upkeep, and then they may not end up getting the $20,000 back that they were owed. Actually, they may not get their $20,000 and it will cost them more. So the price you put on it as a listing agent is very important, especially to a second mortgager, right? But once we decide, okay, this is the price that the property should be marketed for, the bank is going to be shooting for that when they go to the sheriff's sale. Now, if you're representing a buyer, so now we've got a little bit of the background, but now you're representing the buyer coming into this equation. Because I often get, oh, I see this house has been abandoned. They've got the stickers in the window. My neighbor told me about this, and I've got 4 investors that are interested in buying that house. Is there any way that we can buy it now before it hits the sheriff's sale? Because if that's the case, I want to try and get my investor in there to buy it. So this is a conversation that Paul and I were having about a property in Spryfield. Now we're standing out in front of this house and we're assessing it from the exterior and saying, goods and bads, what do you think it's worth? And, obviously there's nobody living here anymore. So how do we get this before it goes to foreclosure? So that's the tricky part, right? You can do it and the transaction can happen, because if at all possible, the bank wants to avoid the foreclosure sale. All they want is their money back. So if you're able to get a hold of the mortgager, the borrower, the homeowner, and say, listen, if your house is on the verge of foreclosure, I would like to buy it so that you can avoid the whole process, right? If you owe the bank $200,000 on your house, I'll give you $215,000. Because if you offer them $200,000, what's the homeowner's incentive to go through that process, sign paperwork, go to the lawyers and stuff? Nothing. They're breaking even. So they can break even by tossing the keys to the bank and forgetting about it. Right? So there's no incentive if you have an investor or you yourself are in looking at buying a foreclosure. There's no incentive to offer them a break-even price. Why would they want to go through all of that headache and all that time signing paperwork, working with the lawyer, working with the bank to come out the same way as if they would have threw the keys to the bank? So you have to offer them a little bit of incentive to go through that process. And for me personally, if they're owed 200, the property's worth 300,000 by the time it's fixed up, well, then you might want to pay this homeowner to sign off on the sale for $210,000 or $215,000. I'll clear your mortgage and you'll have 10 grand in the bank to do whatever you want to do with. They would probably go for that. All right. If you can track down the homeowner, and that's the number one issue. Paul, did you happen to track down the homeowner on that property out in Spryfield?
No, I didn't have any luck. I was
No.
waiting to hear back from the lawyer, and they didn't.
So
He
no
didn't
go.
return my call. I was just thinking that though when you brought it up, I should reach out to him today.
Right. So that's the thing. So if like when you're standing in front of a house and you see the tags in there, it's obviously abandoned. Where's the go-to place to find the information of this ghosted homeowner, right? So what Paul and I did is we went on Property Online. That's my go-to place almost every time I deal with real estate. I go to Property Online and you can get a good sense of what's going on with the property or the property owner through the information that you'll obtain on Property Online. So you can go in there and see how many mortgages they've had in the past, if they actually have a judgment for foreclosure registered against them already. That will show you on Property Online, and will tell you how much the bank is owed, right? So if they get a judgment for foreclosure and the sheriff's sale hasn't happened yet, well, now you know how much the bank is owed and how much they're looking to recover. If you feel the property is worth more, it's more valuable than that amount, then you might want to attend the foreclosure or sheriff's sale, right? But when you're standing at the curb and you're like, okay, how do I find out who these people are and how do I get in contact with them to see if I can buy this property before it goes to sheriff's sale, right? So my best advice to anybody was every avenue that you could possibly find to track these people down. Now you become a PI, right? You're in Property Online. What Paul and I did is we looked at the fact that Clyde Paul and Associates was the law firm that did the last mortgage for these people. All right. So Paul was contacting Clyde Paul to say, hey, Clyde, listen, there's a property that you did a mortgage on, 5 years ago at this address. wondering if you still have contact with those folks. And if you do, would you be willing to reach out to them and let them know I would be interested in making an offer on their property, right? Because that's one way of reaching out to the homeowner, right? Because if the lawyer's office still has their contact information, phone number, email address, or whatever, then the lawyer's office may be willing to reach out and say, hey, listen, I have somebody willing to buy this house. Would you be entertain an offer? And that starts a dialogue. Beyond that, knock on the doors of the neighbors. Hey, do you know your neighbor next door? Like where they might have gone, if you have any forwarding address, or do you have a telephone number for them by any chance or whatever? So ask the neighbors, go door knock either way, right? And find out if they know anything about the property or the property owner. Social media is a good way to track down some of those homeowners, right? Get on Facebook and see, put their names in and see if anything comes up and do some background research there. So if you do end up connecting with that homeowner through any of those avenues, and you pose this to them, okay, obviously you're no longer living there. If there's a chance that you're going to lose this to foreclosure, because I see there's a judgment for foreclosure on the title of the property, I'd like to avoid all that for you by offering you $200,000 if they're owed whatever, 175 or 190, whatever. I'll offer you 200, 205. I will pay off your mortgage and all of your arrears and give you an extra 10 grand. If you're willing to do that, I'll make the offer. Now you'll make the offer subject to the approval of the mortgager that has interest on title, which would be whatever, the first mortgager or the second mortgager or both, right? So once you get the offer accepted, you make sure that you have that clause in there so that the contract then goes to the mortgagers, and the mortgagers will give confirmation. Yes, if we'll let this sale go through, we are getting back what we're owed, and we will discharge our mortgage from the title of this property and allow the sale to go through. And if you can do that before the sheriff's sale, you've now cleared all of the debt. And the banks would be happy to sign off because they get their money back at that point. And that's when you can beat the foreclosure as an investor. Okay. Now, if you decide to go to the sheriff's sale as an investor or a buyer, and this is one thing, you as an agent, if you're working with a buyer and you spot it and bring it to them, that's when the buyer designated brokerage agreement really helps you out. Because sheriff sales don't pay real estate commissions. Would you agree? Be pretty hard to say, okay, this is my bid and you're going to pay me 2.5% of the purchase price as a commission for helping this guy buy it here at the sheriff's sale. That does not happen, right? So you have to have, so our services extend to helping people buy real estate, and it doesn't matter in which form. Could be the foreclosure sale, could be a private sale, could be an MLS or an exclusive. We get paid to help people and navigate them through a transaction, okay? So I've had people that were willing to pay me to help them, guide them through that process. If we can beat the sheriff's sale, great. If we can't, let's go to the sheriff's sale. I will pay you to be there. I will pay you 2.5% of the purchase price when I bid on it and get it. And then I'm going to get you to list it for me when I'm ready to, I fix it all up and put it back on the market. All right. So that's what I do. But your buyer designated brokerage agreement protects you even from them buying from sheriff's sales. Right? They buy real estate, they buy it with you, okay? And you get paid. So if you're going to go through this process of helping an investor or a private buyer looking for a foreclosure, even when it goes to sheriff's sale, make sure you've got your buyer designated brokerage agreement signed so that you will get paid by that purchaser. You're helping them get through this very complex process. So,
Chad, question relating to that.
Yep.
Is there anything special that needs to be written in to the buyer designated brokerage agreement? Is it the standard boilerplate? Nothing's different. We just are covering a geographical area.
So yes, if the sale's within the geographic area or the property is within the geographic area, you are covered. However, this is a broker question, so I can't step over the line and not answer brokers type questions. Right? So I'll refer you to our broker team, but there are conditions that you should put into your agreement of purchase and sale specific to each case, right? So I'm not going to give you guys any advice on that. We'll, put a pin in that one and say, okay, Ann or Sherry or Tammy or whoever's on the broker team that wants to answer that type of question, we'll field that question to them. But yes, there are like any transaction, not everything is the same, right? So there are specific clauses you'll use for specific situations, and that would be one of them, okay? So with the with the going beyond the sheriff's sale. So if your buyer decides to show up at the sheriff's sale and buy at sheriff's sale, and you're going to help them through that process, what they have to know is at sheriff's sale, you get what you get. You do not have the opportunity to do property inspections. So that's a high risk situation. So anybody that calls you and says, hey, I want to go down to the sheriff's sale. Do you have any advice for me? Yep. Lots of advice, because you get what you get. So I said, what happens when you go and show up at the sheriff's sale and there's been an oil spill and now you have possession of that property? That's your problem now. What happens if you show up and there is just no septic system? And you have to, okay, maybe you didn't budget to the fact that there's no working septic system. When you're an investor or you're just a homeowner trying to get a good deal and get in the door, you have to be aware of all these problems that you might find. It could be one or a culmination of problems. Maybe there is an oil spill. Maybe the furnace is broken down. Maybe the septic system's non-existent. Maybe the well runs dry all the time. Could be one or all four of those problems. Would you want to be that buyer on a shoestring budget just because you need to get into a cheap home? No, run like you were running from a burning building when that's the case, because that is not a good idea to have a buyer go in and buy it at a sheriff's sale unless they have deep pockets that they can back up these problems. Okay, so that's one thing that I forewarn people buying at sheriff's sale. It is as is, where is, and you do not have the opportunity to do any inspections on properties when that's the case, right? So it's high risk. Reward, yeah, if you find this property, it's in good shape. Now, if you happen to know somebody that owned the property, you have inside information, well, that's a different story. Maybe that's a good thing. Your neighbor knew these people well, they fell on hard times, but they actually did keep the property up pretty well, the best they could. And as far as the neighbor knows, there really isn't any problems with the property. So that reduces the risk because you have a little bit more information. But if you're showing up blind to bid, not such a good situation, because you could get just about anything when you win that bid. If you win
So
this,
a
Yep.
quick question there for you, Chad, regarding that. So obviously, as is, no PDS, no inspection, but can they view the home? Like, are we able to go in and view the home and actually set our feet inside? No,
Nope.
okay.
Nope. On a
Gotcha.
sheriff sale, and there was a recent tax sale on the 12th. I got it inundated with calls too, with because it's very much the same type of process. Municipality sold off a bunch of properties that were in tax arrears, and I was inundated with telephone calls over the last 2 weeks about leading up to this tax sale on the 12th. You know, what should I do? Blah, blah, blah. So it's a lot of the same advice I'm giving you that I was giving them, right? You know, you're getting what you're getting. You don't have the chance. Nobody's standing there saying, oh, we're ready to auction this off. We're going to have 3 days of viewings, and then you can go down to the sheriff's sale and bid. You don't get that. You drive by and you look at what you're getting from the curb, right? Even wandering onto the property, you're trespassing, by the way. So a lot of people think just because those tags are in the windows. Now, Paul and I didn't quite pay attention to that particular rule. You know, we were gawking in the windows and, you know, walking around the property because, you know, this is, but anyway, we were actually trespassing. However, you don't have the right to do that, right? If somebody shoos you off the property, yeah, they have every right to do that. If they're the property owner, that is, or the management company. But you're the only way you get to know about this property is by asking questions of people that might have some answers for you, or driving by and seeing the physical location from the curb. You have every right to do that. So when you win the bid at the sheriff's sale, you put down 10% non-refundable. You win the bid. So if you bid 200,000, you're putting 20 grand down, and it's up to you within 30 days to come up with the balance of the money and arrange financing. And then you pay off the bank, and then you get title to the property. Okay. However, if the bank takes it over, and this is the majority of the time, so if you want to beat the bank, that's how you do it. If it goes to the bank has a process. They put it on the market. Now we're going to switch gears, and you are now the buyer's agent. A house goes on the market, it's being listed with another real estate firm or brokerage, or even ours. And you say, okay, it just went on the market, looks like a good deal. What now? Has anybody else sold any foreclosures that are attending here today? Nobody else has sold any foreclosures? Okay. One thing you'll notice about foreclosures is if the people have not had the money to pay their mortgage and prevent from losing the home, do you think they're up on the home maintenance? No. The number one thing, and it's the strangest thing in the world, you guys, it's the strangest thing. If you go through as many foreclosure homes that have been foreclosed on as I have, it's the strangest thing. They all have the exact same smell. Like, it's a weird smell and you just get used to it. Now, some have like strong pet odors, like cats peeing in the house all the time and all that kind of smell. But that closed up, musty, dank smell, they all have it, right? Because the management company goes in there and they secure the property, but they winterize it. They turn off the water. They've got temporary heating sources going, all that kind of stuff. But they all kind of carry the same smell. But you'll notice when you're going through the property that they'll all need work, every one of them. And it's because they ran out of money, right? And if they're not paying the bank, they're not keeping up on everything. They're not getting the furnace serviced, the chimney cleaned, the septic system pumped out. They're not scraping and painting the exterior. They didn't pressure wash anything. I mean, you know, you're getting into the same lack of maintenance and deferred maintenance and neglect, house after house after house. So some people think, okay, because of its condition and it's a bank foreclosure, I'm going to get a smoking deal on this. I'm going to write a low ball offer. So it's on the market for, say, 3 or 4 days, and it's listed for $199,000, and you offer them $135,000. Okay, there's a reason why they can't just go ahead and accept that. Okay, they have to take into consideration that if they take somebody's home away from them, do they have the legal authority to dismiss the $100,000 of equity that this person has in it? Can they just dump that person's money and get just what they're owed? There's a responsibility for the banks to chase market value, and there's a matrix that they have to adhere by. And that is, they get an opinion of value from the real estate agent. They get an appraisal done of the property. They go to the board, you know, the management team at the collections division, and they assess each one of these properties, and then they put it on the market. Because if all of a sudden, say a bank takes a property that is valued at $400,000 and it's got a $200,000 mortgage on it, does the bank have the right just to take over the house because somebody got sick and couldn't pay their bills and give away the $200,000? Right? We take it back and we're just getting what we're owed. $400,000 value goes to the market at $200,000. It's not fair on the homeowner because they got sick and were behind on their payments, that they should have their $200,000 cast away. So the bank goes and they pursue market value, and they put it on their house on the market. And they have a certain amount of room that they can move in their price. But once you get to that, they have the decision of accepting it or having to reject it. Sorry, at this point, we're rejecting it. You have to come up. And if you hit into that range of acceptability, then they'll accept the offer. But if you don't, then they have to reject the offers. Then after 30 days, they will have to prove, if they have to go to court and say, hey, listen, we chased market value the best. This is what the real estate agent did. They did this marketing for the 30 days. They had so many showings, 0 offers. We tried to pursue market value for 30 days, didn't get it. So then we reduced the price, and then they sit on that price for another 30 days. They go, they collect all of their evidence. You fill out a report saying, hey, I did this and I did that and I did this for marketing. We had so many showings, still no offers. Okay, after 30 days, they then go ahead and reduce the price again until they get into that sweet spot where buyers then start saying, okay, now that's more in line with market value, and I'll pay you this much. And if it falls within that range of acceptability, they'll take the offer and the sale will go through. Okay, so that's why when a foreclosure goes on the market, don't think that it's 200,000, I'm going to offer them 135 or 150 because it's a bank and they just want to get rid of it. Well, yes, they want to get rid of it to a certain extent, but they have a responsibility to chase market value, and they need to recover as much money as they can. Okay, because they also have deficiencies that they report to their management, and they are shareholders. They lose a ton of money because they were just dumping properties. Well, they have somebody to answer to, so they don't want weak deficiency on their records, even as from the collections point of view. Right, so they're not in the habit of dumping properties. Now, you will eventually come across the situation if the homeowner's home was taken from them and the bank repossesses it and they're the mortgager in possession, they put it on the market for sale. one of the things that happens is if there is a shortfall, they repossess it, they go on the market, they originally owed 200,000, it's only worth $200,000. But the bank had to pay the management company, the lawyer's fees, any maintenance and repairs, and real estate fees, which is probably all toll. And I've seen this over and over again. It's around $20,000 to dispose of a property from the bank's perspective. All right, so that seems to be the magic number, around 20 grand. Okay, we were owed 200,000 and we sold it for 200,000, but we have $20,000 of deficiency here. That goes to the bad debt department. And the bad debt department calls the homeowner who they repossessed the home from and said, you owe us 20 grand. And they chase them and chase them and chase them until they get the $20,000 or they settle with these people. But imagine then if the house sells for 180 and is owed 200,000. So there's a $20,000 deficiency just in the sale value plus $20,000 of related expenses to dispose of it. Now this homeowner owns $40,000 and they will chase that homeowner for the $40,000 to recover it. So on the opposite side, if you're going to chase me after the sale for the bad debt, if there's anything left over, that actual property owner gets the equity back. So if they repossess it, they're owed 200,000 and they sell it for 400,000, the bank gets their 200,000 plus costs, and whatever's left over goes back to the former property owner, right? So that's why they protect the equity that's in the property, right? And they can't just dump them the day after they list it. Now, if the person goes bankrupt, they file with a trustee in bankruptcy, and there's no equity in the property, then the bank has no equity to protect. It's up to them at that point to dump the property for whatever price they feel like selling it for. So the collection agent that has it on their files, or the legal department that's working with that file or that particular property for sale, if they get an offer in, and it's a low offer compared to the list price, and they don't owe anything, responsibilities back to the homeowner because they've already declared bankruptcy and forfeited any right to equity, then the bank is at liberty to sign off on any amount of money, right? That's up to them. So if you do a lowball offer and they accept it, you were one of the lucky ones, one of the very small percentages of the time that the bank just wanted to get rid of it. Sometimes it's year end, it affects their numbers, their quarterly numbers. The more that they reduce the deficiency out there on their books, the bigger their bonus is. So those are the sweet spots that time of year when they're doing their quarterly filings. How much deficiency am I holding? Ooh, if I have a little bit less deficiency, then I'm bonused another 2 grand this month. You write the offer and that helps their numbers get into a lower deficiency amount so that they get a $2,000 bonus. Chances are that collection agent is going to sign off on that deal so that they can lower their deficiency on their books and get that $2,000 bonus that their company will pay them, right? So there are times where you can get your offer accepted at a lower price, but it's very rare. So don't bank on that when you're working with your clients, and just tell them, like, this is a long shot. If you're going to make this kind of offer, be prepared it's going to be rejected outright. So that's what happens when houses go first on the market. When you go and show these properties, you're going to get the appetite of investors who are going to try and lowball and try and talk you into writing low offers and things. But at the end of the day, it's not a very effective way or a very effective approach. When a bank's got a property on the market for 60, 90, 120 days, now they're very, very interested in seeing an offer. Despite what the offer amount is, they are going to give it some serious consideration, right? Because after that amount of time, it's time to get rid of this property, get it off the books. They don't want to chase the money for 6 months, right? If it's on for 3 to 4 months, you're going to know then, okay, there's a good chance we're going to get a good deal on this property. Having said that, there is a lot of reasons why other buyers have come and gone, okay? You're going to get foreclosures in good condition, poor condition, or like very poor condition, right? You can basically count on that, right? There are going to be all different levels of property condition when the bank takes it back. So you as a buyer's agent representing a buyer, you should be very familiar with costing. Okay, when you go into a property and you have to, and there's a lot, most of the time it's flooring, hardware, cabinetry, just kind of cosmetic updates. Sometimes it's windows, sometimes it's a roof, sometimes it's a heating system or whatever, but you should be able to ballpark the costs. What is it going to cost to get this house in the same marketable condition as the other houses that weren't foreclosures, right? Okay, that house sold and it was polished up, it was nice, it had a new roof, functioning heating system and things like that. Okay, you have to put those numbers together and come up with an average of what it's going to cost to bring the house from this level to this level, and that's what you should be considering as your the advantage that you're going to give to your investor client or your buyer client to say, okay, although you're buying it at 180,000, it's going to cost you about $30,000 to get it up to market standard, right? And if you put that $30,000 into the house, then you've got something marketable, or you'll get it up to that standard. And guess what? For $30,000, you can bring it up to a standard at $215,000 your cost. But once you do that, this house is marketable and will sell at $250,000 to $265,000. You're going to make $45,000 to $60,000 on this deal if you buy it as it is and put the $30,000 into it, right? When you make the offer, okay, now that you've decided the value of this property and as is condition, what it's worth to buy now and what it's going to take to bring it up to market standards, and you say, okay, there's room there, there's profit. If I buy this house and I do this, and it's my cost is $215,000, but it's worth $255,000, $260,000. Okay, well, there's $40,000 of margin there. Maybe there's a little bit more. When you make the offer on the property on behalf of your buyer, you're buying it in as is where is condition. Okay. The benefit of buying it from the bank instead of at the sheriff's sale is the fact that you can put conditions into your agreement of purchase and sale, due diligence conditions, which are you're allowed to do inspections on the property before you ultimately agree to buy it. But in this situation, when the finance company puts the house, the foreclosed house, on the market, there's a schedule that they want attached to every agreement of purchase and sale. And that's all the understanding that we are the mortgager in possession and we give no warranty about anything at all. And that is, we don't warrant anything about the title of the property, whether it's good, clear title, that there are, maybe encroachments or other liens or encumbrances to the title. We don't warrant anything to do with title. And we don't warrant anything to do with the physical being of the property, and whether or not there's anything outside of that, external influences, whether, there was a murder suicide in the house, whether it's next to an old refuse disposal site, nothing. It is completely and 100% up to the buyer to discover what they're buying, right? Tangible and intangible. It's totally up to the buyer to discover that. So when you're making your offer, there is a Schedule A that's going to be attached to that saying we warrant nothing. It is as is where is, and it's redundant for almost 3 pages long of all of the things that let the seller off the hook. Total indemnity. Okay, so they won't sell you that house unless that's attached and the buyer understands you're getting what you're getting. Simple as that. And they have to sign on that. Now, when you go to do your due diligence, you have to put in, you have to understand that not all banks work the same. Not all finance companies work the same. Okay. I was able to have some influence because of the type of results that I was getting when I was representing these guys, because I did so much business with them that I knew what they needed, and I knew how all of the objections and the things that were stopping sales and things that were giving the sale the green light. So they were really listening to me. When I gave them advice, they would usually take it. But not all banks work that way. It is what it is, right? So if there's no power at the property, well, we're not spending the money to put the power on. Well, how do you do a performance evaluation on a home if it doesn't have any power? How are we going to draw water out of the well and test it? If it's got an effluent pump chamber for the septic system, how do we activate that? Right, and make sure that the septic system's working and all those things. Water test results, right? How do we get a water test from the well in order to see if it's potable water, in order to get the financing to buy this? Some banks don't care. Figure it out, right? my folks were, I was happy to work with them because they understood in order to move these properties, we have to give a little bit of an effort here. Send the management company out. Now, normally when you put your offer in and it's accepted, you run through the due diligence. They're not going to spend money unless you get to the point where it's time to do those performance evaluations. Just because you got an accepted offer doesn't mean they're going to run out and hook up the power and they're going to, get the furnace running and get the well pump on. My folks did that, but other banks won't do that. But my folks didn't do that until we got an approval of financing letter, right? Because they go out and they send the management company to get everything up and running, and then we have to terminate the deal because they didn't get their financing on this one. So that's frustrating. So they stopped doing that and they just said, okay, when we get the letter of financing approval, then we'll turn on the lights and we get the furnace up and running and get the well running so that you can take your water sample and do your performance evaluation. But not in every case will every bank and every management company do that for the buyer, right? Sometimes in order to get water out of the well, and if anybody was here during the vacant land seminar that we did a panel with Alex, myself, and the gentleman down in Shelburne. John Foss, right. Sorry, John, if you're listening. There is a way to be able to get water out of the well without having the power source to the home. Because when we're dealing with vacant land, there are wells that you can get water out of, but you have to bring a generator or lower down a cup or whatever you need to do. And I've done that in foreclosures in the past. Dean Walker's come out and he's extracted without having the power to the house. He was able to get down into the well, draw a water sample, have it tested, and we dealt with the results, whatever they were. So you are permitted to do those types of evaluations. And sometimes, most of the time, I'm going to say, the bank will cooperate. The house does have power. The well water is running. Those types of things, because they understand if they don't do these things, it's going to make it much harder for them to sell these properties. Okay. Now, if you look at in the agreement of purchase and sale, it says on the water and septic schedule specifically that the seller is going to go and dig up the septic system and for you to do all your performance evaluations. Not in this case. And that's part of the Schedule A. Part of their responsibilities to you, take out any responsibilities that we put on them in the agreement, our standard agreement of purchase and sale, right? So it says the seller agrees or the seller will do this and the seller will do that. In the Schedule A, it says, we're not doing anything unless we want to. We're not going to be bound legally to have to go out and pump out the septic tank because it hasn't been pumped out in the last 2 years. We're not there to unearth the septic tank. That's up to your buyer to arrange. Okay, we don't know where the septic tank is, so a guy like Dean Walker can go out there with his gear, find out where the tank is. Then they would either have to dig it up by hand or bring in a machine to unearth the septic tank and do the full inspection. All right, but that will be the buyer's responsibility because I can guarantee you the bank is not sending the management company out to do that work for you. Right, so they are harder to do. Foreclosures are much harder to do, and it's not like information is available. That's the other part of selling foreclosures. Information is not easily accessible because the bank doesn't know most of the stuff. All they said is it worth it? Do you have the ability to pay us back if we lend it to you? Great. That's the extent of their knowledge, right? So everything else is on you and on the buyer to discover every material fact about that property, okay, before they go forward. And there's such limited information available. So there is a great deal of work. One thing that I always talk to any buyer of anything they buy is to make sure they have a detailed conversation with their lawyer about title insurance. Because that goes a long way, guys, when it comes to finding something after the buyer takes possession of the home, right? So I've dealt with properties where even the mortgagers take title insurance without having to do title investigations. And I had a property over in Seaforth that was landlocked. The bank took it back and we couldn't sell it. We put it on the market. Joan Carroll from Remax a long time ago brought me an offer and they did their title search and she said, Chad, we got a problem. There's no legal access to get this property. We have to cross over private land to get there. And there is no written arrangement in place for us to be able to, my buyer, if they close on this property, that next door neighbor could prevent my buyer from accessing the property because we have no legal right to cross her property. This property is landlocked and not saleable. So thankfully, it was HSBC Finance. They use Chicago Title, which is a title insurance company. Okay, we don't need to do a title investigation. We'll just buy title insurance, and whatever happens, the title insurance company will deal with it. Well, Chicago Title had to step in, and they had to negotiate with the neighbors to try and settle with them to buy access across their property in a right of way to get to that house before we could sell it. Same thing, if your buyers end up buying a property and something like this comes back, whether it's a foreclosure or not a foreclosure, they should always investigate title insurance, right? To make sure that if something comes up subsequent to them taking possession, that they're covered, right? The title insurance company will go to bat and they will settle with the person that has claim against them, all right? So title insurance will also cover you when you go to sheriff's sale, by the way. It's whatever real estate you buy. If they're willing to place a title insurance policy on that property, whether it's a sheriff's sale, or it's a bank foreclosure, an estate sale, or a regular resale home, there's title insurance coverage, and it covers an awful lot of problems, right? So if you close on a property and it's all up to you to discover the material facts, but let's say you don't know, see, Janice. So if you don't know that your garage was built on the neighbor's property, because you couldn't discover it because that information wasn't available. There was nobody to tell you that there was an encroachment on the neighbor's property. There was no survey or location certificate that was available. How were you able to find that out? Right. And when you buy in, and then all of a sudden the neighbor has their property surveyed because they're doing improvements, and they realize, hey, your garage is built on my property, and I need that section of my property for this project that I'm doing. You need to move your garage because it is encroaching on me. That's something that the title insurance company will deal with. They may have to relocate your garage and carry the expense, or settle with the neighbor and pay them out with compensation because of it, right? That's the important part of buying bank foreclosures, because there's a lot to try and discover where there's an absence of information, right? So there's there's different tools and mechanisms in place for you to help reduce risk and protect your buyer clients. And title insurance, buying foreclosures is definitely one of those instruments, okay? So get your buyer always, whether it's no matter what, when you have buyers, talk to them about buying title insurance, because not every lawyer has that conversation. But if you jog their memory and send them to the lawyer to talk specifically about title insurance, I would specifically do that more than any other transaction in foreclosures, okay? When there's a problem, some people ask in the transaction, okay, so we did our inspection and more things came up, like the furnace will not work, it's dead, or the septic system's gone. Can we get the bank to put in a new furnace? Can we get the bank to put in a new septic field? Not likely. They're not in the business of fixing up houses to sell them, right? It's as is, where is. You come across the problem, we'll reduce the price. We're not fixing the problem, right? They're not going to invest more money than they already have into this house because they're already losing money. And there's a chance that they're going to lose more money if they put in a new furnace and something happens, you end up not buying the house, right? You get there on closing date, the bank's not going to sue you for failure to complete. They're just going to roll it over, put it on the market the next day, and hopefully they can get the money. If they agree to put in a new furnace by closing and they do that and you don't end up closing, then they're going back to the market and they may not get the money back that they paid to have the furnace put in. So they're not in the business of investing more money into properties. They want to make sure that they're just going to get what they get at the end of the day under the agreement that you've got. So if you come across a problem with the furnace needs to be replaced, or the roof is leaking and nobody knew that until the inspector found it, or if they did a well flow test and there's no water, or the septic systems failed and needs to be replaced, they will renegotiate. They understand that it's not just their problem, the current buyer's problem, it's the seller's problem, and the next buyer is going to have the exact same issue, right? So there is a good possibility that they will renegotiate terms, but you have to be reasonable. Banks are not stupid people. They're billion-dollar machines, right? $1 billion institutions. They don't get to that level without, making good business decisions. So they're not going to be taken advantage of in most cases. So you have to be reasonable. And the person on the other side, you have to make a solid argument as to why. Okay, this septic system is done. It's leaching out onto the neighbors. If you don't fix this, the neighbor is going to know about this now, and you're going to have to deal with it anyway. Even as the mortgager in possession, they will have to fix this. The Department of Environment will force them to fix it, right? So it will have to be fixed. They will have to realize the septic system, nobody can move into this house without a functioning septic system. I paid you top dollar, and now the septic system is not working. I want a price reduction. We got a quote, here it is. You want to get another quote, go get one, but we're being reasonable at $16,500 for a new sloping sand filter system. We want $16,000 off the price of the house so that we can get this new system put in. Bank, almost 100% of the time, will agree to that. So you can renegotiate, because that's a question that comes up quite often. Like, one, can you do inspections? Yes, you can, but there's limitations, right? You have to work with those limitations. There's no power. The furnace is not running. Bank is not going to send somebody in there to get the furnace up and running for you, right? You might have to write into the agreement that they give you permission to bring in a burner technician and try and get it up and running. If they say, yes, go ahead. If you want to do that at your expense, we give you permission to do that. So, all right, Paul, take it easy, buddy. So that's how you get through the motions of your conditions of the agreement on a bank foreclosure, right? You approach it very much in the same way you would approach any other transaction, but you have to realize they're much harder. There's much more information. There's more involvement. What I don't understand, and this is something that everybody is a little bit on edge over this last week because of the article and the interview that came out about the agents in Toronto, I guess, were overheard on a spy cam talking about commissions, right? Influencing their buyers to go away and buy something else, more so because the seller was not paying a fair commission in the eyes of the agents, and they were caught on tape saying that specifically. So it's anti-competitive when it comes down to it. So again, going back to your buyer designated brokerage agreement, writing deals on foreclosures, the way I present a buyer designated brokerage agreement is that I am working for you as the buyer. So ultimately you are responsible to pay me. The good news is the seller will pay part or all of that commission. That's the good news in most cases. But ultimately, in the absence of full commission or a commission at all, you will be responsible to pay me. So that's a buyer designated brokerage agreement. If you look at bank foreclosures, I could flash it up and I will show you, all of these banks that have retained the services of an agent and paying 1.75% as a commission to help them to sell their foreclosure. That I would immediately talk to my buyer client and say, hey, listen, you realize that we have a contract. Me personally, I charge 2.5% of the purchase price of the property purchased by the buyer. The buyer is ultimately responsible for 2.5% to pay me that commission. So I would have to have that conversation and say, okay, this foreclosure, this bank is offering, or the seller is offering, or seller's brokerage is offering 1.75% as a commission. You're going to have to make up the other 0.75% if you decide to buy this foreclosure. So it's already expensive in the investigation and the repairs and all the risk that might come. You have to charge your buyer the extra percentage because I don't understand it. There's a whole lot more work involved in helping those types of sellers sell those properties. And the commission rates that they're offering are, what I'm finding, much lower than 2.5% that I charge to represent a buyer, right? So that's the nature of it. And I just, it doesn't, honestly, you're working on behalf of your buyer, but it doesn't incentivize the buyer's agent to want to go and sell those types of properties. They might want to release the buyer. Like, I don't work for 1.75%. And if you're not going to pay me, I'm not putting all that time and energy in for that type of compensation. So I'll have to release you from the buyer designated brokerage agreement if you're not going to pay me the difference, right? Because you're going to spend an awful lot of time and energy on a foreclosure where the banks and the buyers, the sellers brokerages are not paying what you feel is worth the time and compensation. Okay, so I'm finding that more and more. Now, thankfully, HSBC always paid 5%. They understand, you know, the results that we are getting for them and rewarding us accordingly, right? So they always paid me. And sometimes in the more rural areas like Sheet Harbor or Ship Harbor or somewhere down the Eastern Shore over the last 10 years, that market has softened and it was harder to sell. They were paying us 6%. They volunteered that amount. I didn't ask for it. I still would have done it for 5, but they gave me 6 because they understood it's going to be a longer haul. It's going to be a lot more energy. And they said, okay, if you're listing this, it's going to be a 120-day listing and sign it up for 6%. That's great. But know that it's a lot of work. So have that conversation with your buyers that oftentimes and I don't know what you guys all charge for your, to represent buyers through a buyer transaction. And it can be different. I mean, some people are out charging 2%, some people are charging 2.5%. But if you look at a very complex transaction, you might want to charge 3%. You're going to put a whole lot more time and energy in. So if that's the case, you might want to charge 3% or a certain percentage in a flat rate, whatever. You're permitted to do that. So just know that. And if you're going to take on buyer business to buy foreclosures, there's a lot involved. There's a great deal, and there's a lot that can go wrong because so many properties are neglected, not having proper maintenance. So obviously, if you're not maintaining your furnace well, do you think it's going to perform properly? It's going to need repairs and upgrades and a serious servicing because it hasn't been done in 10 years. The septic system hasn't been pumped out in 15 years because didn't have the money to pump it out. What do you think the field is going to look like after 15 years of not pumping out the solids? It's going to be in pretty rough shape. So there's a lot of stuff that you have to counsel your client and guide them through when it comes to foreclosures, right? Once you've gone through the due diligence section and you've looked at you got the financing in place. And by the way, when you're helping a buyer to buy a private sale or a bank foreclosure, what's the one thing that a bank will always want to do? Gesundheit. Gesundheit. What's the one thing a bank will want to do if you are helping somebody buy and finance a private sale or a bank foreclosure?
Would they want an assessment done? Maybe.
Qualify assessment. What type of assessment?
Well, they'd obviously they'd have to be approved for the mortgage. So the bank, would they do an assessment on the property and find out what it's worth?
Right. So appraisal.
Appraisal, right.
There you go.
Find out if it's worth what it's worth.
Exactly. Yeah. Right. So 100% of the time now, every foreclosure and every private sale is going to trigger an appraisal of that property. So when you're writing your clauses into your agreement of purchase and sale, you want to make sure that you have enough time to get through the approval, the preliminary approval stage with the bank, potentially then CMHC insurance, and then beyond that, time for an appraisal, right? Because if somebody's coming in with only 10% down or 15% down, and if 20% down, there's definitely going to be an appraisal. But you have to make sure that there's time for that. You can't put a weak clause on a finance clause if you expect that they're going to appraise it, because they are going to appraise it. And right now, especially now, it's taking sometimes 2 to 3 weeks to be able to book in an appraiser and get the results back, right? So just make sure that when you're writing the agreement of purchase and sale, it has that in it, that extra time for the finance clause. When it comes to the title of the property, okay, the title is to be conveyed by way of whatever type of instrument of deed. So when it comes to banks, they cannot provide a warranty deed. One, they will not warrant anything. But if you know the difference with a warranty deed and other types of deeds, a warranty deed is a knowledgeable title holder, knowing that there's nothing that they're aware of in title that would encumber the ability for them to convey title to you, right? They know the history in the background. They've had a title search done maybe when they bought it and it was clear title. So there's a knowledge that that property owner has that they can convey under warranty, right? The bank can't do that. They're just a mortgager in possession. So they have an interest in this property only because they financed it and they need to get the money out. right? So when they convey title to the property, it's by way of quit claim deed. Now, some people think, what's a quick claim? It's not Q-U-I-C-K, it's Q-U-I-T, right? Quit claim deed, which means I've ceased my interests in this property. I've quit my claims against this property, right? So that's the way the property is going to be conveyed, under quit claim deed. So if you are going to write an offer on a property that's been foreclosed or being held by a bank, that's the instrument of title that they will be conveying, right? Just so that when you get to that line, most people, and I've had this a lot of times, and I've just had this with a mobile home that I sold, people putting in warranty deed, right? It's not a warranty deed that's going to be conveyed in either of those situations. They're two different titles that are being conveyed. Yeah, so.
Okay, Chad, I remember, because I was trying to remember where I saw that. I took a screenshot and sent it to my mentor. And
Okay.
that's, I saw it on the mobile home. Yeah,
Right.
okay. I'm glad we talked about that.
Homes are by bill of sale or general conveyance.
Right,
That's how they're conveyed over, because they're not on a PID with a
Right.
deed title to land. It's to a chattel, a possession, right? So, all right, so that's pretty much, from the beginning of the end and how somebody, starts getting in trouble to the foreclosure sale, to the sheriff's sale, right on to getting onto the market, and, your ability to do certain things, and the banks kind of, they are willing to cooperate to a certain degree, but, you can't push them around, guys. I will say that. It's like you being, trying to push around a billionaire. You're going to do what I say. Good luck, right? They're in control, but they're reasonable, right? They are dealing with a lot of people that are unreasonable often. So they become very desensitized to people and their arguments and the reasons why. They look at the number. If it makes sense, they'll do it. If it doesn't make sense, goodbye. I'm not doing this deal with you. So that's basically how it all pans out. They're not so rigid as they won't listen to, okay, there's problems with the property, and this is the reason why it should not be valued the same way. When you look at a property, or anything for that matter, that has warranty and one doesn't, so property disclosure, whether it's resale, if it's like a foreclosure sale or whatever, bank repossession, if something has property disclosure and one property has property disclosure and one doesn't, are they worth the same amount of money to you? I know it's not for me, because if I'm buying a house that has warranty and all this information that comes, it's reducing the risk for me. So I will pay more to that seller because they've reduced the risk for me. With something that does not have property disclosure, I'm not paying an equal amount of money for one that does have, because I'm assuming more risk. And because I'm assuming the risk, I want to pay less money. You're taking the risk by giving me this information, right? And you're helping reduce the risk for me. So it's the risk reward principle, right? So if I have to buy a house where there is absolutely no warranty anywhere and everything is on me to discover, that's a lot more risk. And because of that, I am not willing to pay you the same amount of money as I would pay for a property next door that's offering total warranty and disclosure, right? So just bear that in mind. So when you're formulating your offers, have that conversation with your buyer client to say, that is the reason why, all things being equal, one has warranty and one doesn't though. Okay, you're going to pay less for a reason, because you're assuming more risk with the lack of information. Okay.
How about, excuse me, Chad, how about some, like for like normal sale, how about some seller, they don't provide a PDS, but they provided, home inspection to you, the recent report to you. How about this?
Yeah, I mean, it's valuable to a certain degree. However, the seller, like a location certificate, is going to give you a property inspection report, but does not warrant it. Okay, if you were representing a seller and the seller was providing an inspection report to a buyer, I would recommend that you, as the seller's agent, make sure that there's a clause in the contract saying, just like when the seller is responsible for providing a location certificate, if available, the seller does not represent the accuracy of the information, does not warrant the accuracy of the information, and any reliance on that information is at the buyer's risk. Okay, because all that's doing is saying, oh, here's the inspection report, and it's perceived as a warranty that this is the actual condition of the house.
Mhm.
But if the inspector made mistakes,
Yeah.
that would be between the current homeowner and the inspector, not the buyer and the inspector, right? Because the seller is providing this as though it's warranty. Oh, I had an inspection and this is the inspection results. So if the buyer takes that at face value and relies on that information to buy the house, and then it's not accurate, the inspector made a mistake, missed, say, knob and tube wiring throughout the house, and it's going to cost $12,000 to fix. Well, you gave me an inspection report that didn't indicate this. And so when the seller provided that information, there should be a disclaimer on there saying, if you're going to rely on this, it's totally at your risk. So it does, in some senses, lower the amount of risk, but not entirely. Okay, so there's still risk when the seller says, oh, I'm not going to offer you property disclosure, but I'm going to offer you an inspection report. Yeah, but I still would not offer that as warranty, right? I'm not warranting that this is actually the condition. I'm just telling you that I had an inspector in to do a pre-listing inspection, and this is what he found. However, I'm not warranting that to you.
And if any issue happen like after closing, so the buyer can still sue the seller.
They could try, but if you put that clause in there protecting the seller, saying that they do not represent or warrant any of the information and any reliance is at the buyer's risk, then the seller's off the hook. They can sue, anybody can sue anybody for anything, right? If they feel like they have a valid reason to go to court, and you'd have to go to court and defend yourself. Simple as that, right or wrong, right? But if you had that clause in there that relieves the seller of any obligations under warranty, then they would not have a leg to stand on sitting in court saying, oh, but they gave me this inspection report and it turned out to be wrong. Yeah.
Okay. Yeah. Thank you.
Okay. So, again, going back to some of the inspections, water inspection, right? Get a water company to go in there, take a sample. If it comes back and it's got arsenic and uranium or all these cosmetic issues with the water, or it's got bacteria, obviously the bank is going to want to make sure that they can convey the property with potable water. Otherwise, it's going to be, you're going to eliminate probably 85% of the best buyers out there because they need to finance this property, right? The 15% of the people that don't need to finance are the people that want big deals anyway, right? So you want to make sure that you want to cater to the 85% that are capable and willing to buy these properties. Problem is, if you can't supply a potable water sample to the bank, they're not going to fund the mortgage, right? So if you come across a problem with a property that has bacteria in the water, or if it's got arsenic or uranium in the water, then it's non-potable anymore. It's got health related issues involved. So the bank's going to have to recognize that. In most cases that I've dealt with, if there's bacteria, they will send the management company out, shock the well, purge the water through the system to sanitize the pipework throughout the house, and then put on an ultraviolet light source to kill any bacteria going forward. That's my experience. They're normally willing to do that. Or they're willing to put a reverse osmosis system to treat arsenic or uranium, but only at the drinking source, because that's like $750, as opposed to a whole home system, which is probably $3,000 or more, right? And they're not going to do that to treat the whole home. They're going to provide potable water to the house, and that is a $750 reverse osmosis system under the kitchen sink. So financing foreclosures. People ask me, is there any difference in financing foreclosures? And there's not. The only difference is it will always be subject to the results of an appraisal. Okay, you can still put 5% down. The banks are still going to look at the application. I mean, they're going to be a little skeptical at some points, like they're going to look at it and say, okay, there's an elevated risk, but so long as the appraisal comes in and the appraiser says it's worth what you're paying and has this condition, then we'll do it, right? So there's no difference. Knowing that there's $20,000 on the average to upgrade foreclosures, what is the best finance package that you could guide your client into to buy foreclosures?
Home plus improvements?
Absolutely. Okay, did you guys get the email from Kathy Parker by any chance? Are you guys affiliated with Kathy Parker with Premier Mortgage? Okay, if you guys want it, I can forward it to you, but she came out with a new mortgager. Okay, purchase plus improvement loans. Traditionally how they work, and this is one thing that I have done when I represented. So I'm going to be doing another one of these sessions on the 19th, but it's not going to be representing buyers. It's going to be listing and selling foreclosures. One of the things that I did in terms of marketing and trying to promote, because I know the challenges in selling foreclosures as a listing agent. People come in and they just have these great ambitions, and it's usually young first-time home buyers because, hey, this is right in my wheelhouse in terms of price, but they walk in and there's so much work to do. And then that's when they start name dropping that my uncle's an electrician and my cousin does flooring and this guy's a painter, and they're calling the world of favors in to buy this house, right? Sometimes it's just great ambitions, but it's not really going to come to fruition for them, unfortunately. So one of the things that I was prepared for is I went through the house and I took a couple of hours to go through the house room for room, and I marked down what would it need to bring this room to modern standards, to today's marketable standards based on all of the other houses that have sold like this in the area. And I go room from room, and then I would go away for another few hours and I try to quantify that. How much would it cost for all of this flooring and all of this painting, and to repair do the kitchen over, or bathrooms, or replace the roof shingles or some of the windows, or the furnace is obviously not working anymore. The oil tank needs to be replaced. I had to go through and itemize every one of those things that needed to be dealt with and then assigned a value. And then I would normally get in around 20,000 bucks, right? For the average size home, I was about $20,000 on occasion. Sometimes you get 30 or 35 grand of improvement costs and things like that. So what I had to do, and this was when I was working with Home Loans Canada, because they're a subset, or used to be, of CIBC, and I had a good relationship with some of the brokers there. So I would say, I need information on purchase plus improvement loans, because I'm going to be marketing to a lot of people that need the extra money that don't have it to repair this house or bring this house up to a certain standard, right? So, so I would partner with somebody like that. So for you, it's the same thing. If you're going to endeavor to do foreclosures, it's a good idea to have somebody that you're aligned with that can help navigate the financial side of the purchase of a foreclosure. Because if you have $40,000 or $20,000 or $30,000 worth of improvements to do, where's that money going to come from? Right? That's a long road for a first-time home buyer trying to fix up a bank foreclosure, right? So a purchase plus improvement loan is ideal to be able to get the house fixed up so that they're not just, spending $2 or $3 grand a year for the next 10 years to try and get this house just to average market standards, because not everybody's flush for money. Not everybody can go in there and just do it, right? So you have to have some options to support your buyers to be able to help them obtain the financing they need to make it a livable and happy home for them, right? So now Kathy came out with a new lender that is doing a draw system, because the traditional purchase plus improvement loan, you have to finance the improvements on your own. Once the improvements are done, the bank comes in and inspects the work that you've done to ensure that it was done, and then they will release the improvement money back to you. But not everybody has the resources to be able to pay for all of this and then get it back from the bank. So that's been a challenge. So what Kathy brought was a new lender that identified with this, and they're doing draw systems. You can do $5,000 or $10,000 worth of work, and then you can draw the $10,000 and get the money back. And then you can do the next phase and get the money back in the next phase. So they do it the same as like the draw structure in new construction on a contract agreement, right? So that was a good product that Kathy just came out, and I will.
Ed, sorry, is that related only to foreclosures and new construction, or could any client who potentially wanted to do like a reno on a property they're just purchasing, could they also, I assume, take advantage of that draw system?
If they're in the process of purchasing, yes.
Okay,
A refinance is different. You're just going to refinance if you got the equity in your home. If you're an existing homeowner ready to do a renovation and don't have the money, well, then you go to the bank and look at, maybe refinancing or putting in a line of credit against your house in order to do that. But yes, when you're buying, you have the opportunity to go through that lender to do the purchase plus improvement on it.
yeah, I'm interested in that draw aspect of it. So I put my email, my work email in the chat for you.
Yep.
I'm
Sure.
really interested in getting that info because I am talking a lot about purchase plus improvements with clients in general terms and not really talking specific lenders.
Yep.
They have people already, but I think that's fantastic.
Yeah, for sure. Yep.
Hey, Chad, another quick question. Is there a specific time of the year in which you'd see more foreclosures than others? Other times of the year?
Not really. It comes in spurts. Unfortunately, there was some reason why everything lined up that I was starting to get foreclosures in like February and March. And that's not the best time to put a house on the market.
No, but it does kind of speak to overspending at Christmas and how kind of things come into roost and they kind of sacrifice some things to make Christmas for people and then they're far behind and
Yep.
It's kind of snowballs to that time of year.
Yep, 100%. Yep. So that is, there are different times of year, and coming towards the end of the year, I look at it and say, these collection people in the legal department, they want to finish the year without having great big deficiencies on their books, because that helps their numbers when it comes to the structure of their company, right? So it comes down to, yeah, if we're coming in and I can close this property and they can get the money in and pay down the deficiency to make their deficiencies on their books a lot smaller, well, that's going to help their year-end results. So they're definitely going to get bonused on that. Right.
Yeah, it makes sense, right? Because everybody has their year-end numbers. There's timelines for everything, right? So.
Yeah. And it really seems a bit corrupt at the end of the day, but it's the reality, right? I've seen it. I've actually had internal auditors calling me about that very thing. The internal auditors were like, Chad, I need to go over some of your files, because they were trying to keep their collections people in check, making sure they didn't dump properties intentionally to get bigger bonuses, right? So I've had people, and I called my buddy and I was like, Andy, I just got this call from this guy and he wants to meet with me and review files. I said, I'm not doing that unless I know he's got authorization. And he's like, whoa, that's one of our internal auditors, and he's got somebody on his sites, which means somebody that I've been dealing with, or somebody that's been dealing with the East Coast, is being suspected of dumping properties to lower their deficiency, costing, let's say, all right, I'm going to lose $20,000 for the company, so I get a $2,000 bonus at the end of the month, right? That happens. So if they dump 3 properties, $20,000 each less than market value, that's 60 grand to the company, so that they can get a $3,000 or $4,000 bonus by the end of the year or the end of the quarter. So the internal auditors are all over that. So I got a call, and there were certain files that he wanted to have a look at. Anyway, I had to involve our legal team and our broker in it. I'm like, unless this guy's got some right to come in and audit our files, I need to hear that from the seller and give him authorization, because this is sharing confidential information. I need that in writing. So I had to bring the broker in, and I called my buddy at the branch and I was like, ooh, Andy, like, who's this guy and why does he think he's got the right to audit these files? Anyway, the audit never did happen. If he needed to audit files, he needed to go to Montreal and sift through their files, not through our files at the brokerage, as it turned out. But
I do find that a lot of people from away, maybe not so much in the current market that we find ourselves in, but in previous markets, they would look at our prices for homes and go like, what do you mean you sold it for that much? I mean, obviously you're dumping the property. It's like, no, that was probably the market value at the time.
Yeah, absolutely. Could well be.
Like now I get it. Like now people are complaining. They're like, geez, for that price, I could buy a property in Ontario. And you're like,
yeah.
Feel free to do that then, because you're not going to get a $1.5 million home for 700 grand here. It's not happening anymore.
Yeah. And that's what people think. They think that foreclosures, they can just target foreclosures and get great deals. You have to be patient like every other investor. Deals don't come along every day, right? But you got to be able to spot what is a good deal and what's not a good deal, right? And just on the surface, if it looks like it's a good deal, once you get into it, it may turn out to be not such a good deal, right? So you just have to play it like any other investment and any other real estate transaction. Assess it the best way you can and allow the buyer to make the best decision that they can.
Well, and thank you for this, Chad, because I think that you're arming us with a lot of really good information. So if nothing else, we can share this with our clients who are considering this and say, hey, listen, it's a marathon, not a sprint. So if you're interested in this, then it's like bargain shopping. You have that one thing that you want to buy. It's not on sale right now. So you need to do a lot of research, find it so you understand what it's supposed to look like when it is a good deal, not just grabbing it hot. Okay. No, I really appreciate that. This was a great big gray area for me. And to be honest, I'm going to have to go back and watch this video again.
Right.
I feel like I've got a lot going on in here now, as usual, but I definitely appreciate this. This is incredible. Good info.
Yep, my pleasure. All right.
Thanks, Chad.
My
Appreciate
pleasure. So, last call for questions. So if anybody else has questions, throw them out. If not, we'll end it there.
I'm solid. I wouldn't even know what the heck to ask at this point.
Right on. All right. Well, revisit this, and if I'll be doing it again from the listing perspective on the 19th. So feel free to bring some questions and join me then.
Awesome. Definitely.
Thank you.
Okay,
Thank you
guys.
so much.
Thank you, Chad.
You're welcome. Have a great day, everybody.
Awesome.
You
See
too.
ya.
Bye.
Thanks.
Bye-bye.
Bye.